Payment Pulse, a podcast by Clearent by Xplor, a leading full-service payments provider. Welcome to Payment Pulse, a podcast by Clearent by Xplor, where our goal is to humanize and simplify the complex world of payments. My name is Steve, and I'm here with my co-host Max. And today we're going to kind of just start with a quick introduction to who we are. I don't think we've really done too much of that, maybe a little bit in the intro, but just so that we have context on like how we're structuring these conversations and who's ultimately the SME in each category, if you will. Again, my name is Steve. I am the Senior Marketing Manager here at Clearent. I primarily focus on the software ISV channel, but that's my core responsibility and you know where I come into play today. I've worked in payments for the last 6.5, 7 years, starting all the way out at a customer service level, speaking directly with merchants. That experience holds near and dear to my heart, and it was a very critical aspect of my career, and being really at the grassroots of the pain points that some of these merchants are experiencing. And so that's kind of where my experience comes into play. But Max, how about yourself?
Yeah, I appreciate the intro, Steve. You're definitely more of a seasoned payments person than I am. My background is more of the economics and finance world. So I came to Explore about 2 years ago now, and I work in our finance FP&A department, managing our US and UK markets. And so my background, however, is in public policy and economics. And so prior to being at Explore, I was at Ernst& Young for 2 years, working in quantitative economics and basically breaking down a lot of the economic cycles that we're seeing, and understanding how companies, big and Fortune 500 companies, all the way down to small municipalities, influence our economy. So, yeah, really excited because I think payments, the reason we started this podcast is because I think we wanted to put our two brains together and kind of say like what is happening across the economy and what's happening, in these smaller markets, and how can small businesses kind of react to it all. So really excited about where we're going with this, and you know that we're working on this together.
Yeah, man. Yeah. It's two different perspectives, but that's really the beauty of it. And hopefully we can continue to deliver, value from our own perspectives. With that being said, it's a perfect segue with your introduction of yourself there. Our topic today is how macroeconomics factor influences, consumer decision making, specifically regarding payment technologies. In the last few episodes, we've covered how microeconomics help provide a framework for understanding consumer decision making, how consumers respond to emotional and social influence while shopping, and also how trust and risk impact consumer psychology. But today, we're going to take a look at the bigger picture and how larger economic trends impact the way consumers think about spending and, ultimately their payment preferences. At Clearent, as providers of, payments and software solutions, it's vital for us to understand not only individual consumer choices, but also broader economic conditions shaping those choices. Whether that's, between cash, credit card, mobile payments, or, why certain technologies thrive in specific economic climates. We're really here to break it all down. But with that said, Max, before we dive into the specifics, can you just quickly define what we mean when, we're talking about macroeconomics?
Yeah, absolutely, Steve. So, in our second episode, we talked about microeconomics, and microeconomics focuses on the individual and small group decisions. Well, macroeconomics expands that definition and looks at the economic conditions of a nation or at a global scale. We're talking about big picture factors like inflation, interest rates, money supply, labor markets, overall consumer confidence. These forces are the ones that shape the entire economy's performance and are directly influential over the consumer's individual decisions day to day. So, yeah, it's taking this kind of aggregated view of microeconomics and expanding it to the entire nation of the world.
Yeah, it's a great summary, Max. Perfect way to start. So let's, really jump right in from there. Starting with inflation, we see it everywhere. It's literally in our faces on the news, on social media. Can you help explain how rising prices impact consumer payment behavior?
Yeah. Inflation, simply put, means our money buys less than it used to. Recent 2024 data showed that 30% of consumers have cut back their spending due to inflation. And with many, of these changes in inflation, their budgets have changed as well. We've essentially taken, essential goods and put that at the top of our list over, kind of discretionary items. So you might have noticed that like groceries, utilities, your rent, all have increased. It leaves less money for, left over for, another hat, another uh, favorite pair of shoes, all these kind of collector's items or discretionary items. Essentially, what this means is like inflation erodes our purchasing power. Um, as consumers, we become more sensitive to transaction costs and friction, really, in the consuming process, and it prompts a noticeable shift towards more efficient payment technologies. For instance, mobile payment solutions have surged in popularity during inflationary periods since they offer reduced friction. Rewards programs, budget tracking features help consumers manage spending better than under economic conditions that are inflationary. Credit cards with these strong rewards programs are another great example. Over 83% of consumers hold these rewards programs, cards with rewards programs, and typically you'll see a surge in the use of these cards during inflationary periods because it offers this kind of hedge against inflation, so that they can earn cash back or points, and in their minds, offsetting some of the rising costs. So
Yeah, that's pretty interesting. Yeah, so kind of what you're saying is payment technologies are actually helping people navigate inflation strategically.
yeah,
And so that's really interesting. But let's shift gears from that, to interest rates. Another headline grabber, how does this, come into play?
yeah, yeah. So interest rates are sort of you can think about it in the way of like it's the government, it's the banking system's way of controlling inflation. It essentially influences how much it costs to borrow money, and without getting too complicated, it impacts how consumers choose to pay for goods and services. So in a lower interest rate environment, you know, we see borrowing is cheaper. So, it borrowing in the sense, let's just take credit cards for example, means that you probably spend more and use your credit card more because the borrowing on credit will be cheaper. However, when it's a lower when interest rates rise, borrowing becomes more expensive, and so consumers will probably reduce their credit card usage and turn more to debit or alternative payments like cash, or maybe a buy now pay later, or a check. So interest rates create this kind of like cyclical pattern of consumer payment preferences, and payment providers have to kind of evolve to understand, if we're in a high interest rate environment, then people are probably going to revert to debit and credit. If we're in a low interest rate environment, we're going to probably see the opposite. And so merchants, uh, card providers, processors all know that this is like a massive, a very like easy thing to track because like we can just go in and see like, hey, is the Fed going to cut rates? Are they going to raise rates? So it's a very like tangible thing we can go out into the economy and see.
Yeah, no, that makes sense. I appreciate the explanation there. Let's jump to this next one. It's a bit more abstract, but let's touch on the money supply. How does that influence payments as well?
Yeah, so this is the fun part, the interesting part about this podcast, Steve, is like we said, we're going like really like we started with microeconomics and we like had all these analogies about like things you and I decided on, and like we came up with, our utility curve, and we were saying like, oh man, like we're happy with some type of um, combination of hats and hats and watches, and like it's all really like you can kind of understand it like because it's like a very like real world type of thing you can see and feel. This is like one of these things with macroeconomics. Like I don't think anyone can really feel or see money supply. Like it's just it's like trying to understand physics, and like we all saw some of those like physics movies and you're like, dude, how are people coming up with this? But like I'll try to distill this down into like a tangible um, kind of example. Money supply. Let me try to define it, and then I'll try to give you an example of why it's impactful to purchasing decisions. Money supply is generally like um, this concept that influences overall purchasing power. So it's essentially like this term that helps to define the strength of your money. When the money, so when we say like the money supply expands, it means that we're spending more. If we see that like there's more money in the economy, we see printing of money more the greater printing of money, we have more money to spend. However, just as we mentioned a couple seconds ago, the more money we have to spend, the higher prices will go. So like it will see inflation increase, meaning that like actually each like the next dollar we're spending to pay like the next dollar we spend loses its purchasing power. So, you know, that if we expand the money supply, we see a strong demand for payment technologies that, optimize for, security, transparency, and really like optimize for high credit card usage, high mobile platform usage, because people are like tearing away at their you know power, right? Essentially. So it's this delicate balance where like if we see more money in the economy, if you and I feel that we have more money to spend, we're gonna go spend it. But it's chances are that our neighbor and all the people in our in the rest of the economy are also feeling that, and so it's it's just like this weird dynamic where essentially we have to like be mindful that we're we're not creating inflation for ourselves. So it's like this weird thing. Now, what I'll kind of let's take a step back and say like, why are we even talking about money supply if it's like not something that like you can really put your finger on? The reason why it's important for payments is that when the money supply expands and consumers like you and I feel like we have more power, we have more money to spend, and we decide to use that in electronic payments, it actually helps the rest of the economy work better. The reason being is that when you and I use just cash or a check or some traditional payment method, that money tends to like stay sedentary after that transaction. Meaning what that what that cash is then used for in the next transaction. So if you go to your merchant and you say like, "Hey, I'm going to pay for a can of Coke," and I paid $2 for that, and I hand them $2 in cash, chances are those $2 in cash are going to stay in that cash register, or in that merchant's bank for in a longer period of time than if I go and pay with my my tap to pay Apple Card. Um, and that is like the interesting part of electronic payments and why it creates it's stimulating to the economy is that when you pay with electronic payments, it actually has like a greater impact on the second and third order effects. It more quickly like reshuffles through the economy, and we have more money supply circulating through the economy. So this is more of like a call to action of like, hey, be good to your neighbor. If you want to be good to your neighbor, if you want to be good to like the rest of like your local economy, you'll pay with you'll pay with mobile payments, you'll pay with your credit card, you'll pay with something that is kind of tech enabled, because chances are that there's going to be a shorter window of time between when that money is then used for the next transaction, than if you use check and cash.
Yeah, no, it's a fantastic way to think about it, or an interesting way to think about it, I should say. But it makes total sense. With that said, let's move on to the next one here. we're looking at labor markets and consumer confidence. How does
Yeah.
that relate to payment technology and overall the adoption of it?
Yeah. So labor market conditions and consumer confidence are really closely linked. When consumers feel secure about employment and incomes, they're more inclined to adopt, these kind of innovative payment methods. Um, recent recent consumer confidence data showed a cautious optimism about the labor market recently, despite the lingering concerns about prices and interest rates. So we should see that like this stable environment encourages consumers to experiment with newer technologies. Um, you know, buy now, pay later, uh, tap to pay, virtual um, virtual wallets, because they're gonna just perceive the risk less than if they were like tight on cash, tight on or worried about like their income. So hopefully that makes sense.
Yeah, no, it does, yeah. And speaking of perceived risk, that was one thing that stood out. Our research from the last episode highlighted something, called a trust premium in established payment methods, particularly during uncertain economic times. Can you expand on that concept in this case a little more too?
Yeah, absolutely. So when economic uncertainty arises, think recessions or a volatile financial market. I mean, kind of like what we've experienced so far in the last couple months of this year. Consumers become like hyper aware of the potential risks. Often preferring the established, trustworthy payment methods over newer, less tested technologies. Established methods are these, credit cards or the widely accepted mobile payment providers that we know have security and transparency and fraud detection, and we can, it just creates peace of mind. And so it's being well aware that like if you're a merchant and you're considering taking on a new payment method, um, it's also understanding that like, does that have product market fit within like your consumer base? Are you gonna like bring a new piece of technology on and like no one's gonna use it because they're kind of like worried about where the economy is going and they don't really want to test their kind of risk tolerance at this moment? It's something to consider for sure.
Yeah, absolutely a consideration. Yeah, very insightful little segment of that risk piece that we talked about last week, or an episode ago, I should say.
Mhm.
Definitely go check that one out. It's super important, that risk perception and creating a stronger relationship from a merchant to consumer level. So, but yeah, let's pivot here briefly, real quick, to how payment providers adapt technology strategically in response to these macro shifts. Can you walk us through some of these examples?
Yeah. So during economic downturns, we've seen that there's been this kind of slow adjustment by the payments industry to enhance budget. Basically these personal as well as enterprise value plays from a product perspective. So we've seen budgeting tools and financial management features added to payment products to directly address the heightened like anxiety around consumer confidence. Um, we see buy now features like buy now, pay later gain traction as well, precisely during these periods because they offer financial flexibility to consumers. And providers also ramp up security and protect transparency features because they know that consumers want trust. They want to know that they can understand their finances during economic volatility, like times of economic volatility. So um, the last kind of piece that is a little bit, we'll go back to like the things that don't seem as obvious, but we see like an increase in reward program card usage during these times of inflation to offset some of the rising costs of things that we're purchasing. So we're seeing a little bit of like both the industry adjust using new technologies during times of economic uncertainty. We're also seeing consumers just adjust naturally using what's already available. And so I think the real takeaway is that like we as humans are very adaptable creatures, and like payment technologies are something that we like will adapt to in order to like offset risk for ourselves.
Yeah, those are good examples. Could you give like a real world scenario to just illustrating, maybe some of these strategic adaptions?
Yeah. So let's think of like post-pandemic. I think that's probably the best example. So mobile payment usage notably increased post-pandemic, and it helped stimulate consumption, economic recovery, all that. I can kind of remember the days when like all of a sudden we were all scanning QR codes to pay for something, or we were all like
Hmm.
from a distance like paying, rather than going and like tapping our credit card on a terminal. Um, and like that is like a great example of like a macro, like a an impact on the economy, then changing like how the industry evolved. And so like that rapid adoption highlighted how quickly we adapt to new economic and market conditions. And similarly, like we're seeing this kind of trend, a similar type of adaptation in like emerging economies, where digital finance is really taking off. So, we talk about like I think everyone in the U.S. like has like some level of like it's like hard for us to comprehend that we couldn't have tap to pay, but like in most of the world, like we're still like breaking down structural economic barriers to like entry. And
Hmm.
so we are now seeing like as payment technologies enter these new markets, like we are seeing quick adoption of payment technologies almost immediately because it's offering again like first the consumer like value to the consumer, right? The individual that has that technology available to them. But then it's adding like the next layer of impact to the merchants and all the way down the ladder of the economy after that. So yeah, look, there's so many good examples to pull from, but well, look, we're adaptable. We're adaptable human creatures.
Yeah, I think COVID, just kind of a comment on that, and this is more of a hypothesis, but that was obviously such a dramatic shift, and there was a lot of technology that came along with that and causing those adaptions. Um, but not only did that accelerate the technology, but it also feels like it accelerated the adaption and the adoption of these new technologies as well in the post
Mhm.
pandemic world. So really interesting stuff there.
Yeah.
But let's wrap it up, Max. What strategic insights, should payment technology providers take away from our conversation today?
Yeah, I mean, look, it's what we've been always saying. It's to remain agile, right? If you're an ISV, if you're a payment processor, if you're a merchant, right, that you must remain agile. That like this is just another thing to that macroeconomic factors, whether that's through policy or that's just through the trends in the market. Um, you know, you have to remain aware of what's happening in this world and ensuring that you can have this kind of dual track of features that accommodate both recessionary periods where people are being very cautious about what kind of technologies they're adopting and using to pay for things, but also in expansionary periods when people are a bit more experimental and risk risk averse, not risk averse, risk tolerating, I would say, right? And so, but it's always ensuring that like whether it's your pricing or the rewards programs or security or transparency, like all these are crucial regardless of whether we're in a recessionary or expansionary period of time, and ensuring that like you can kind of track like what you're offering, um, despite whether we're in one of those two conditions. So it's being economically resilient in how your business goes to market, but also in how your business allows your consumers to transact with you. So hopefully that summarizes the conversation in a pretty decent way.
Yeah. Yeah, great insights. I know I learned a lot every time I talk to you about these economic factors. So I always appreciate it for myself personally. But yeah, for everybody else listening too, understanding these macro factors it's beneficial, but it's more essential, to be honest. And for, meeting consumer needs, mitigating risk, and really enhancing resilience, it's critical to really pay attention to this stuff and understand it as well. So, as always, we love hearing from our listeners. Please share your feedback on your experiences, add your questions about today's topic. Got episodes coming up next week and beyond as well. So stay tuned for those. Subscribe to all the listening platforms, whatever your preferred is. You can watch on YouTube, listen on Spotify and Apple Podcasts as well. But until then, we really appreciate y'all listening. Thanks for tuning in to Payment Pulse by Clearent by Xplor. We'll see you next week.